Hello, my name is Patrick Pondo, and today I'll be discussing Enron. Enron was formed in 1985 as an energy trading and utilities company, and in its heyday it was regarded as one of the world's most successful companies. Enron became the crown jewel of America's energy trading industry. Its stock price rose to $90.75 in its prime. However, as incredible as the company seemed, its legacy was not the same as many other successful organizations, as Enron was not as well managed as many had thought. Enron was responsible for one of the worst cases of accounting fraud in recent history, and the regulatory policies that have been in place after its fall have changed the business landscape immensely. I would first like to discuss Enron as a company and how it got to become so successful, and then move on to the illegal activity that caused the once mighty company to crumble. Enron was formed by way of a merger of Houston Natural Gas Company and InterNorth Inc. This merger resulted in the previous CEO of Houston Natural Gas Co., Kenneth Lay, to become Enron's new CEO and chairman. Kenneth Lay's plan involved rebranding Enron and making a leader in America's energy industry. His plan started off with a rebranding, turning the company into an energy trader and supplier instead of a utilities and pipeline-focused company, which were the specialties of the two companies before they merged. The regulatory climate that was present at the time allowed Enron to become incredibly successful. The company was able to expand its gas line and power plant operations exponentially. Enron's growth and successful projects led it to win Fortune's America's Most Innovative Company Award 5 times in a row in the late 1990s. Enron's most successful project came in the form of its online energy trading business. This was the company's answer to the dot-com boom that was occurring in the late 1990s. Enron joined the group of internet stocks that were booming by creating its own online platform, known as Enron Online, or EOL for short. The website launched in October of 1990 and was created as a trading website that focused on selling commodities such as oil. Enron made themselves a counterparty for each transaction, meaning that they were either the buyer or the seller in each trade that occurred on the website. Enron also chose to create markets for various unpopular commodity products like weather futures and internet bandwidth. Enron sold partners and potential users by using its reputation, notifying these parties that their prowess in the industry would make them the best trading site on the market. The Federal Energy Regulation Commission stated that the transactions included both the purchase and sale of commodities. EOL supported over 8,000 transactions a day, totaling about $3 billion worth of energy products daily. All of this success would mean nothing in the end. Once the turn of the century came, Enron's collapse began. Enron's downfall came as a result of the burst of the so-called internet bubble in the early 2000s. The recession that came following this left Enron in very bad shape, as it had tremendous exposure to the markets that were affected, namely their online trading business, and their value as a business began to drop drastically. This was partially caused by the company's mark-to-market accounting scheme, which basically meant that the company was incorrectly pricing its assets to hide the losses of its projects. When Enron's projects with these assets failed to be profitable, they would transfer the assets to an off-the-books fake organization where the losses were written off. These actions made the company appear profitable, but the world noticed something suspicious was happening, and analysts began to lower their rating on Enron's stock. The accounting firm in charge of keeping Enron's books was Arthur Andersen LLP, and they were also a part of the issue. Arthur Andersen was one of the 5 largest accounting firms at the time and was known for its high standards and professionalism in its accounting practices. While knowing about Enron's illegal activity, Arthur Andersen LLP did nothing to interfere and was eventually prosecuted for engaging in fraud with Enron. In 2001, the company began to tank drastically. Once the company's lack of transparency became troublesome to the investing world, and 2 CEOs of the firm left the company in a matter of 6 months, Enron's stock dropped from around $90 per share to $39.95 per share. The company posted its first ever quarterly loss in October of 2001 and began to close some of its off-the-books corporations. This caught the eye of the SEC, the Securities and Exchange Commission, and they launched an investigation on Enron, which caused the stock to plummet to $20.75 per share. The company was then forced to restate its earnings all the way back to 1997, in which they actually posted $591 million in losses and had $628 million in debt on their balance sheet. The company filed for bankruptcy on December 2, 2001, and the stock closed at a price of 26 cents per share that day. In response to this, regulatory bodies brought in numerous new regulatory policies to prevent something like this from happening again. The Sarbanes-Oxley Act was passed in 2002 by the Bush administration, which heightened the consequences for destroying, altering, or fabricating financial records and trying to defraud shareholders. The Financial Accounting Standards Board also raised requirements for ethical conduct and the punishment for breaching them. The level of criminality involved in Enron's business practices was astounding, and the fact that the company got away with it for so long was even more shocking. Enron was America's leading energy company in its early days, and was listed as one of America's most innovative companies. However, Enron's success was ultimately cut short by the recession at the turn of the century, and their fraudulent activity was brought to light. The fall of Enron was an embarrassing but necessary wake-up call for regulatory agencies, and once the mess was cleaned up, new policies would help to hinder companies that would attempt to commit accounting fraud in the future. Thanks for listening.